Okay, thinking about higher interest rates and consumers and stuff, let's talk Wells Fargo. Their revenue came in at 19.66 billion, which was down 5%. Their earnings per share came in at 67 cents, which was down by 51%. That was mostly due to, well, their net interest income was up, like you would expect from pretty much everybody, only about 25%, which is less than Bank of America or JP Morgan. And Wells Fargo are a consumer-based bank, but higher credit loss reserve, as you might expect, and a 3.7 billion settlement fee for some slightly fraudy activities. I don't think this is the kind of big thing. It's to do with assessing people for loans and that kind of thing. And their fee income was lower and stuff like asset management, mostly because lower markets mean lower assets under management. Basically, the value of the assets or the price of the assets they own went down. That's what they charge fees based on. So they collected less in the way of fees on that. Wells Fargo, Steve, did that surprise you, by the way? Or did you know about that in advance?
No, I hadn't actually checked on Wells Fargo. They're the bank I often forget about. I think they like to think of themselves as like recurring revenue for the US government, don't they? But it is interesting to see that their net interest income is not as high as the other banks, especially that they specialise in an area where you'd think they would have been able to jack up the rates a little bit. So it was interesting to see that. Another 3.7 billion settlement fee. That's hopefully, I mean, we've said this for, I think, 2 years now, Steve, but hopefully that's the end of that. It would be nice to see Wells Fargo move away from this kind of constantly paying fines of around £3 billion plus, $3 billion plus, sorry. But yeah, I think broadly you've covered most of it here. Asset management, lower assets under management, I mean, that's just going to come with the territory. Even if you're in the S&P, it's fallen 20%. That's difficult to make that up. Yeah, interesting for me. Wells Fargo, is it on your watch list?
Yes, it feels like the turnaround story that continues to turn, doesn't it? It feels like every time you think, okay, they've started working their way. And in fairness, this is Charlie Scharf is the CEO there. He's taken over since the scandal, and he has not been talking, from what I understand it, of this being soon. He's not been. It's not like Elon Musk with a truck, right? It's not like he keeps saying next year, next year, next year, next year or something. He's very much talking about this being slower and a longer process than investors might be hoping for. My main takeaway from this is that it shows that you can do enough to bugger up a good situation for your bank then if you get into enough trouble, because as you were rightly saying, this Wells Fargo seems like the bank that is structurally best positioned to take advantage of higher rates, especially for consumer lending, and pretty well protected against investment banking losses, because investment banks are just not part of what they do. There was a kind of lazy-ish rumour going around when I started investing that they were going to merge with Goldman with a view to putting together a consumer arm and a investment bank arm or trading arm. That obviously hasn't happened yet. So I guess you can't say it didn't happen until one or other of them goes out of existence. But this feels like that with enough pressure, and this I guess really illustrates how deep the problems are at Wells Fargo, that in a good environment they're still under pressure there.
Yeah, it was nice to see them responding to issues ahead of things. I know back in December they let quite a large amount of their mortgage lending team go, and I think that's in response to the fact that there just won't be the demand for them there. I think they'll earn more from mortgages, but the demand to actually issue new mortgages will start to decline, or probably already has started to decline. And it was nice to see Wells Fargo jump ahead there and at least get the layoffs started. There's actually layoffs pretty much across the board in banks in their mortgage space. I know JP Morgan have laid off a few as well. So these are cyclical things. Mortgages are cyclical products. So unfortunately for those staff, they're probably not in as safe a job as they thought they were maybe 9 months ago.
No, and banking in general is quite a cyclical industry. Maybe not the two parts of the investment banks, the other kind of big bank stuff we were talking about from Bank of America and JP Morgan. They kind of move in opposition to each other a little bit. And that's not to say that they're equally good or equally profitable or equally desirable segments, but it is to say that, well, one of them protects the other one a little bit. And it might be that you're always being weighed down by one of them.